All right, for those of you coming in, we appreciate you taking the time to join us this evening. I'm your host, Stephen Lee Thomas. We got a few other people that'll be joining in the presentation this evening, and we will be covering a really great investment opportunity in Cleburne. It's a self-storage deal, 504 units. It's an amazing opportunity. We're going to dig into that tonight. So I appreciate you taking the time to join us. And again, those of you that are just joining, I know we've got a number of people who have registered for the webinar and another large group of people who have registered through the Zoom event. And so they may be registering real time, and that's okay. We're going to give them a couple moments to get in. You'll see here I have Bryce and Janice and Dee Dee with me this evening. So they will be hosting along with me. And my name is Stephen Lee Thomas, if we've never met before. And we're going to be covering the Cleburne self-storage deal. It is a self-storage deal we're very excited about. We're excited to bring this opportunity to you. We're going to dive deep. We're going to cover all the details in this webinar. Lots of really exciting stuff. I'm going to do a quick check on the attendees and see if we got about everybody in here. So here's the deal, folks. I do a lot better when I get participation from the people that are on the call. We don't do these webinars for us. We know this information really, really, really good. So we have a couple of asks for you. One is we'd like you to participate. If you have questions, it's really, really, really important. We want to answer all of those. So our promise to you, here's our promise. Our promise to you is that we're going to do everything we can to present the information so that by the end of this webinar, you have a very strong sense of whether you're ready to invest. So what that means is pay a lot of attention and ask questions, okay? If there's something you don't understand, ask questions. We have time at the end of this webinar where we're going to answer your questions, okay? We have committed to stay on as long as it takes. We want you to have answers to all of your questions about this deal. That's our commitment to you. We strongly believe in this deal. It's one of the best deals I've seen in a very, very long time. That's why we're very excited about it, okay? So that is, ask number one is please put questions in here, okay? And the other thing too is please participate. So I want to start off a little bit really quick with the participation. Where are you guys dialing in from? Where are you calling in from? Can you just put that in the chat? I want to make sure that our chat works. We're going to be monitoring that. Put your questions in along the way, but let's just get started here. Can I get some participation in the chat? Can we see where are you guys calling in from? So we've got Paula from Cedar, chat's moving pretty quick. Paula from Cedar Park, just north of Austin. Awesome. South Florida. We've got Leander, Texas, Laura, Southlake, Texas, Nashville, Colorado, Chandler, Arizona. Awesome. So we have a really good mix. And we did the timing on purpose so we could get the most people in the room. We appreciate you, again, taking the time to join us this evening. So Bryce, Janice, Dee Dee, you ready to burn this candle?
Let's go.
All right, let's go.
Let's do this. All right. So one of the things we like to do is give you a nice overview. So we've seen the property a lot. We've walked the property. We've done the due diligence. But something that we think is important is to give you all an overview of the property. So here you can see the flyover. We've got some footage of the property. It's a very large, very well maintained property. We're going to get into more of the details about how new it is and some of the demographics in the surrounding area. You'll see it's right here, conveniently located off the freeway, just south of Fort Worth and very close to Dallas, actually. Lots of growth in this area, which is very exciting to us, which means a really good workforce. So that's one of the big driving factors here in this storage unit deal is there's just so much going on, so many reasons to be excited about this deal. So you can see we'll go more into the market and where things are located, but just fantastic. There's an Amazon distribution center going in. A lot of families are moving into the area. So again, it's just something very exciting for us and this opportunity that we're going to bring to you. So with that, what we're going to do now is we're going to go ahead and we're going to get started with the rest of the presentation. All right. I will cover the agenda. Like I said, we have a lot to cover, but our goal, our commitment to you is we are going to stick around to the end and answer all of your questions. So again, please make sure you get those in the chat. We'll monitor those and we will answer every single one of those before the webinar is over. So we're going to do this. We're going to cover the confidentiality and disclaimers. The sponsor team, we're going to talk about that. The team on this, the summary of why we like the deal. We're going to do a market overview, a property overview. We're going to cover the business plan and some of the financials. An overview of the investor returns. There's a lot of what could be complex numbers here. If you're not really big into the financial numbers here, we're going to break it down. We're going to give you a nice example of what it would look like if you were to invest in this deal. And then every deal has risk. We're going to talk to you about the risk that we've identified and how we're mitigating all of those. what to expect after we close, and then obviously what's next steps. If you're ready to invest or if you've got questions, how do you move forward from there? And then, like I said, we're going to give time for Q&A at the back end. All right. So let's do this. I am not going to read this word for word. I'm going to give you a nice summary here. It's confidentiality and disclaimer. So here's the long and short of it. This overview and plan is for the Cleburne self-storage, and it's confidential and only for prospective investors. This information comes from reliable sources. We've spent a lot of time digging into the details on this property. So with that, we don't make any guarantees or warranties made about this property. We've done everything we can, all the due diligence we can, but there are no warranties or guarantees. All financial projections and assumptions are based on market and economic conditions that we are aware of and to the best of our ability to predict those. So investors must conduct their own due diligence and consult professional advisors if they feel the need. Participation is limited to accredited investors. And so with that, let's dig in a little bit more. Myself, if you've never met me before, my name is Stephen Lee Thomas. I'm a multifamily investor, and I've been doing this for about 7.5 years. I've been able to invest in a little over 1,700 units. I'm a business coach. I'm a webcast host. I have a background in operations and asset management. I really enjoy the marketing side of this, and I have a very strong, deep corporate background, a little bit about me. So I'm going to pass the mic over for a minute to Bryce so he can introduce him and a little bit about the partners from the Boring & Co. group.
Hey everyone, I'm Bryce. I'm the talking head that you get to see for the Boring Group today. Boring & Co. is our family business that's made up of my parents, me, and my three younger siblings. So we started this business about 5 years ago now. And before that, we actually had an advertising agency since 2005, and that's still going strong. So we have over 20 years of business experience in ownership. And along that, we've also, just because of the nature of having a big family, we have a lot of people that are good at filling in different roles. So I am the resident underwriter and acquisitions guy. So I am going to be talking quite a bit for the rest of the show, but I'll turn it over to my mom to cover any bases I haven't.
No, I think you got it. Thanks for letting me jump in. I just think that we've been working really hard and have several storage properties ourselves. And as this lovely slide says, we have about 1,600 units and 200,000 square feet of self-storage and 250,000 square feet of self-parking. So we are excited to look into this opportunity with you guys. It's another really great property that we're excited to take over.
Well, thank you very much. So what I want to do now is I want to talk about why we like this deal. And a lot of this is why I'm personally excited about this deal. And as I mentioned, I've had a lot of background in the multifamily space. This deal in particular really stands out to me. And so I'm going to hit the high points here. We're going to dive deeper into this. Bryce is going to talk to you about the underwriting a little bit later and dive a little bit deeper. But so here's what's going on. The pricing on this deal is very attractive. So we're able to acquire this deal below acquisition cost, below replacement cost, meaning we're able to get this deal at about $68 a square foot. Now, in the multifamily space, a lot of times that's, price per unit, but in the storage, it's actually price per square foot. If you look at comps, they range anywhere from about $100 to $200 per square foot. So what that means to you is on day one after acquisition, the value of the property has already gone up. This is one of the things I really like about the property. The submarket in and of itself, rapidly growing submarket, population growth. I was surprised to learn this, but it's actually about 25% population growth over the last 5 years, and it's expected to continue to grow that much or more. And I'm going to get into a little bit why that's the case, but the fundamentals are there to make this a really good submarket. It's also a very well-maintained asset. So it was built in two phases. The first phase was built in 2018, and then there was an expansion in 2021. So what that means is everything's pretty new. It also means there's very little deferred maintenance, and it's also good to know there's a gated access to the property. And then the last thing I really want to highlight is the value add potential. So as we're going into this, right? So we're already getting it at $68 a square foot, compared to $100 to $200 per square feet. But the rents that are there are also below market. And so you combine that lease up on some of these new units, and there's also some technology upgrades that are going to be implemented that are pretty cool. Once again, Bryce is going to share some of those details with you. So there's a lot of really good things about this deal that we like. But you're saying, Steven, show me the numbers. So I want to show those to you. right out the gate. So a couple refresh here. It's 504 units, built in two phases, 2018, 2021. It's got a great pricing on it, good occupation, great location. We'll show you that. Well maintained, essentially no deferred maintenance, and is also very low operating expenses. Now, Bryce will show you this, but I will tell you, for those of you with a multifamily background, operating expense ratio is generally, if you take your operating expenses, how much is that compared to your income? It's a lot closer to 50%. What you're going to see is this is actually closer to 30%, which is really nice. And I like that a lot about this particular deal. So what does that mean to you as an investor? So if you were to invest in this deal, what this is going to look like for you is average cash on cash, think about like cash flow over the life of the deal. We're looking to hold this for 5 years. It's about 8.8%. That's just the cash flow piece. Your IRR, that stands for your internal rate of return. That's about 19.65%. It has to do with the time value of money. It can be a little bit more complicated. I'm going to summarize that here in a second. Your equity multiples at 2.25, and then your average annualized returns is about a little over 20%. So let me say that back in layman's terms. Your return on investment in this deal is over 100% return on investment in about a 5-year time frame. That's what that means. Your equity multiple, when I show you the example, what you'll see is if you put in $100,000 at the end of the day, we'd give you your $100,000 back plus about $125,000. That's what that means to you. So that's fantastic returns on a deal like this. And then we also are looking at a minimum investment of $100,000. And you will understand why by the time we get to the end of this presentation. There's a lot of excitement for this deal, a lot of interest. And when you look at the numbers, you'll understand why a $100,000 investment makes a lot of sense. So I also want to share with you, why do we like this market? There's a lot of different places we could do this, but why do we like this market? So Dallas, Fort Worth, it's one of the top markets in the United States. There's so much growth going on in Dallas, Fort Worth. So if you look at the top 10 metros, you'll see Dallas ranks number one by absolute change. And then by percent change, they're only at 8.8%, but they just really cast a shadow over the number. So the Metroplex in and of itself is huge, and there's a lot of growth there. It's a landlord friendly, it's business friendly, it's a really good place. So what does that mean? Like, why is that important? Well, what that means is it's much more resistant to economic disruption. So in the event of a recession, it's a great spot. People are moving there. And so when you have those economics, it makes it more resistant to something like recession. This is located just a little bit south of Fort Worth, about 25, 30 minutes. And so what you have is Fort Worth expanding down into this area, a lot of growth down there. Currently in the area, there's about 1,000 new homes being constructed. And there's also, because there's so much growth down there, there's actually an Amazon distribution center. So lots of really good things going on in this area. And that's why we like it so much. All right. Bryce, you're up, man. I'm going to hand it over. So Bryce is going to cover, he's going to go into a lot of the numbers here. He's the numbers guy. Okay. So if you've got questions about the underwriting, the numbers, make sure you drop those in the chat. And when we get to the end of this, we can always circle back and answer those questions for you. Bryce, go ahead, bud.
All right. Thank you very much. So this right here is kind of the 30,000 foot view that is completely analytical and very boring, but it needs to be said, right? So what we have here is a property being purchased at $6.2 million. And throughout the whole, we're going to put about $265,000 worth of capex into that. And I know for a lot of the people that are used to investing in multifamily, that might sound very low, but that's actually above average for storage facilities. And the reason why we're investing them is going to be highlighted in a few pieces later, but it has to do with security, additional income and revenue streams, and then on top of that, just some, I guess, preventative measures, maintenance-wise too. But looking at the numbers here, what you can see is on the pro forma, we have acquisitions starting off, and we have been saying that this is in the mid 80s right now for occupancy. But in self-storage, the economic occupancy is the real number that we want to keep track of because it shows us how much the property is performing to the level that it should be. And right now it's at about 68, maybe 70%, depending on the set of numbers that you have. But for our purposes, it's 68. And by the end of year one, we're hoping to get it to 88%. The way that we think that this is going to happen is one, by increasing the rental or the number of units rented. We have quite a bit that we can rent out right now, somewhere around 60, 70 units, I believe, that still need to be rented out. But then on top of that, we have ECRIs, which is existing customer rental increases. And then we have rental rate increases as well, which would be those web rates that you see whenever you're looking up storage. And you combine that all together in that sort of plan, and we are going to have leaps and bounds happening over the first 2 years. That's why we see in the gross profit a pretty large jump from year one to year two, and then they get a little bit lower, just proportionally, because we're not trying to make this an aggressive play. What we're trying to do is get this ship righted and then ride it out for the rest of the 5 year hold. On top of that, what we're planning on doing with expenses is lowering expenses where we can, which are some operational inefficiencies that KO Self Storage has. And then in other cases, we are actually taking precautions in raising expenses anywhere from 5 to 20%, because of just how we see the market moving and making inflationary increases, as well as just preemptive conservative increases to big ticket items like taxes and insurance. So, I don't want the name of the game here to be quote unquote conservative, because as an underwriter, I hate that term, but we are also not getting way out over our skis here. We're making a measured business plan.
I think the only other thing I would want to highlight here is you can see in the underwriting what I mentioned is the operating expense ratio, and you can see how that drops down
Mhm.
pretty good. And again, and what does that lead to? Without getting overly technical, we start talking about the debt service coverage ratio, and essentially what that means is that is your cash flow, if you will. That's your operating cash, and so the higher the number, the better. And right out of the gate, it becomes a very high. So a lot of great things here. Bryce, anything else
Oh,
you
and
want to
then
add? Go ahead.
yeah, and I think as well as that, it's a great marker of risk. So most lenders, they will not lend on a property unless you can manage a 125 DSCR. And we're expecting a 173 here in year one. So that, coupled with the fact that it's going up every single year, the property is getting less risky, which every property should do that, hopefully. But then on top of that, with the rising DSCR, the cash flows will also be rising throughout the hold.
Absolutely. Bryce, anything else? You want to move to the next slide?
Yeah, let's go to the next slide.
All right. All right. Talk to me about the market analysis and why this is important.
So the Cleburne market is just one of absolutely absurd growth, and it's not Cleburne in itself. It's this daisy chain that lines up all the way to Fort Worth. And if you go and look at the historical data from the last 5, 10 years, what you're seeing is leaps and bounds happening. Every single market going all the way up to Crowley, which is about 5 markets north of us toward the center of Fort Worth, has experienced rent, or not rent growth, but population increases of 10% or more, including Cleburne. And every single one of those is expected to do the same thing in the next 5 years. And I think, there's all sorts of data out here. We have easy analytics software that's tagged here right now. One that I think is really fun to do in Texas is just looking at the giant football stadiums that start getting put up. And there has just been a line of those happening over the last few years, moving on their way to Cleburne. And Cleburne's next up to get one. So it is just a population of growth and abundance happening right now.
Awesome. All right. So now we want to show you a map, right? So it's one of the things that we want to acknowledge. Is there competition? Can there be more? Or no, maybe not. So can you tell us what's going on here on this map?
Yeah. So one question that we actually get asked quite a lot is about the market comps here and whether or not the market is oversaturated with self-storage. And I can say that this market is slightly above average as far as self-storage saturation goes, but it's a market that has absorbed it quite well. So Cleburne has a few things going for it. One, it's a rural market, and rural markets typically absorb that square footage a lot better than tighter markets in prime markets like cities, Fort Worth Center, Dallas Center. But then on top of that, the really big one here is that there's no REIT presence. So there's no extra space, no life storage or public storage.
Hey,
So we're
Bryce,
dealing,
what's a REIT? Can you explain to me what that is? Maybe there's some people on
yes.
that aren't really familiar with REITs.
So that is the real estate investment trust. The closest thing I think could be in the multifamily space would be someone like BlackRock or Vanguard that's just going out and buying up as much as they can. To put it simply, most self-storage facilities are owned by mom and pops, right? That's about 60% of the market. But then 20% of the market are owned by these REITs, public storage, extra space, U-Haul even. And they own thousands of storage facilities. So the scale there, should be well apparent. And the fact that even though they're, from sea to shining sea, but they're not here is just an, absolute gift for us because we're not going to have the biggest fish in the pond trying to fight us for our customers.
Another thing that means, and we might talk about this a little bit more in the risk mitigation, but so it's actually more expensive to build than buy.
Mhm.
So that also means a REIT's not going to come in and build something. They might buy this deal when we're ready to exit, right? But
Mhm.
the there's not tons of competition, and there's not any planned new construction either. Is that correct?
That is correct. The closest new construction is a town over, a little over 4 miles away. And like you said, we are buying this below replacement cost. So if Extra Space wanted to go and build right next to us, it would be slightly more expensive for them to do that. And then they'd have to manage a lease up on top of that. So it doesn't make economic sense for them to come and build right now. And what they are working over, their war rooms is what facilities are already standing and which ones are going to be good for them to acquire. And that is something, in our end goal that we're going to talk about is we have a facility that would be a very good fit for them. And it kind of points to the fact that also just one benefit of selling to a REIT is they pay better than just about anyone else for a property.
Great. On that note, one of the things I want to do, because we're looking at the comps, without having to go there, every single line item here, can you explain why we would look at rent comps and what that means for this particular property?
Yeah. So, we have said that KO is very much, the nicest, newest property on the block, but storage is still full of people that are price conscious, and you can't get out too far ahead of your comps and expect to stay full. Um, so that being said, right now we are actually far below our comps, around 50 or 60%. And based off of those numbers, we have this huge delta that we can take advantage of as soon as we start taking control of the property.
Yeah, that's one of the great things I like here. And so something we do on the multifamily side is we constantly shop the comps. And so we're always looking at what's going on here. But as Bryce mentioned, there's an opportunity to it's a slow incremental increase. And so let me put this in a little bit different perspective. In the world of multifamily, your opportunity to capture what we call loss to lease. Somebody gets into a lease and then they're in it for a year. If inflation goes up or something like that, the market goes up, that person is locked into the price for a year, and that's your opportunity to potentially do a rent increase. Here, Bryce, it's a month to month situation. And so what we're able to do is look at this and on a month to month basis, make very small incremental amounts as needed. So it's not a shotgun approach where year over year, you're like, guess what? Your rent goes up by 100%. No, that's not the case at all. You're much easier. You can spread that out over time. So it gives you a definite
Mhm.
advantage here when it comes to the rent increase on these units.
Yes, and I actually think that I'm guessing it's Theodore Rubinsky, not Rubinsky Theodore. Um, they just asked a very good question about why the prior owner was not able to stabilize the facility ahead of us and what we're going to do differently. And plain and simple, they had where they were slightly below market rents, but they were at a very good occupancy of about 90%. Um, but what they then did is instead of trying to make these incremental increases like we're planning on doing, they tried to not only make the big leap, but they tried to leapfrog entirely the competition to where they were 20, 30% higher in rents than the competition. And I would love to get there with this facility, but it's going to take us a little bit of time to get that because we're going to do it in a measured approach that is not going to put us at risk of dropping 10, 15% of our occupancy, in the span of a couple of months. Um, and what we do by this, shopping the comps, I love that term. We do the same thing where we are constantly looking at our comps around us, and we have a facility that's just 30 minutes down the road where we're constantly doing that because our whole strategy with that facility was we want to be about 10% behind everyone else because if we do that, we're going to absolutely blitz past our numbers, and we can do that here too. So it's a very measured but exciting approach.
Great. Well, what I'd like you to do now, if you don't mind, Bryce, is we've gone over a number of slides, but if you could give us like a summary and go through kind of bullet point out the business plan overview, how this is all going to come together. So we have a few things going on. There's the exterior upgrades. There's some increase to income, right? Your general like
Mhm.
rental income, think of that, some additional income, and then expense reduction. Can you walk us through, since you're the one that's really big into the numbers and the underwriting, can you walk us through each of these?
Yep. So the big thing here is it's kind of a you build it, they will come strategy. we're highlighting the security upgrades because that is one of the big things that people love to see at their storage facility. They like to see it well lit at night. That is one of the biggest threat deterrences in self storage. They like to see cameras that are going down every single alley. They like to see gates that have unique codes for everybody that's there. And that's the bulk of the security package that we plan on doing that. But then on top of that, we have this really cool piece of technology called Storage Defender that we plan on implementing. Uh, and that is going to be another very large piece of capex for us. And it has the chance to really add quite a lot of additional income for us. But I'll talk about that in just a little bit. First, what we're planning on doing is increasing the occupancy, right? The average occupancy in the US right now is actually sitting at about 92%. So our goal of 88 is fairly conservative by that same measure. But in this submarket specifically, most of the facilities are at 95 or higher, with many of them having waitlisted units or their entire facility waitlisted. So we absolutely think that it is possible to get a near completely occupied facility. And what that will allow us to do is then play with the actual rents and the incremental rent increases that we have planned even more so. And it gives us a little bit more sway and a little more power to execute our business plan. And just all of that kind of working in cohesion with each other gives us more stability that we will be very appreciative of in the future. So now onto the additional income. And this is one that I get very excited about because self-storage, it got a bad name in that people think it's just a race to the bottom. Sometimes, kind of like the Australian wine market, where it's just let's find the cheapest thing we can. But truly, self-storage has a customer base that appreciates good things, and they will enjoy us having a more A-class facility here. But more importantly, we're going to be getting a lot of our additional income from additional service. And that's something that just a lot of facilities don't offer. So we're going to be offering a very good tenant insurance program, something that frankly, I wouldn't recommend anyone not have something like tenant insurance for their own storage unit or facility. And we actually have one that is very investor friendly, meaning that we are sort of bucking the old trend of about a 50-50 split on revenue for us and the insurance company. And it's going to be closer to about 80 or 90% of that revenue going to us. And then, Didi, I think you're muted if you were wanting to chime in.
No, as soon as you're finished with that thought, Bryce, we do have several questions that I feel like we should probably get to before we get too far down, and I don't want anybody's question to get missed. But
Okay.
thank you guys for asking all the questions. We're going to get to all of them. So as soon as you're done.
Great. So then we have Storage Defender, and Storage Defender is this really cool piece of tech. It is effectively like a Ring doorbell for your storage unit. And anytime it's open, it's going to send a text to your phone. It has a camera in there to see what's going on. And in some cases, it can be uh, send notifications about climate control issues as if it's getting too cold or too hot. We don't have any climate control at this facility, so we don't need that service, but it's there if we do. And it's just all this really cool stuff. And again, it's something that people find a lot of security in, and it is a deciding factor. And we've even been in the office of some of our storage facilities where we've had this guy in his 50s or 60s, and he's just gung ho about Storage Defender because he likes the idea that he's going to see the guy's face that's trying to break into his unit, and he's going to go grab his shotgun, and we have to say, "Oh no,
Not
us."
okay. So
Yeah.
so here's like from an underwriting standpoint, an important note about this Storage Defender is this item in particular is not actually underwritten into the deal, meaning this does not have to ever even go into place for the deal to make sense. This is icing on the cake, so to speak. Okay, so this is proven, already, having conversations, market tested. This is something that will go in and will just add additional revenue to the property. That's like that's just going to be icing on the cake on top of the cash flow and returns that's already there.
Exactly. And frankly, we're putting it in as a full CapEx item as if we're going to put it on every single unit because we've started implementing it piecemeal into our other facilities. And the revenue gain and the adoption rate has just been wild. The only reason why we haven't included it into the numbers here is that we've only been implementing it since about April of this year, which is not a very long time to get reliable data on absorption rate. But after a year or so, we might be able to, fine tune things and see, how much we can really reliably expect to absorb every single month. And that will be great for underwriting deals in the future. But with this one, anything from that is going to be just that icing on the cake. So,
So we have just a few more things here. Reduced insurance premium. That's something Janice has been spearheading for us. Thank you so much, Janice. Reduce management expenses, and then we're going to come back to that in just a minute, and then contest property taxes. So this is something, if you're not familiar with the Texas market, you can actually contest your property taxes, which is cool and interesting at all the same time. So what that means is you're not stuck with what's being assessed, and it is actually part of the business plan is to it doesn't mean you get to have them go away completely, but it is something that you can do, and it helps you control that cost a bit more. So, but the last bullet here, and Bryce, I'm going to let you run with this one, is reduce management expenses, because you guys have some experience with this, and there's some operational inefficiencies that are going to be going away once we take over the property. So, can you expand on that a little bit?
yeah, so really operational inefficiency is the key word here. KO is a larger operator. They're not quite at that REIT level where they have thousands of facilities, but they have about 250 all across the US. And this property, just for whatever reason, it's not in one of their sort of focused local markets that is close to home for them. And it's gotten a bit of the redheaded stepchild treatment. And I get to say that because I'm a ginger. So we're local to the area. We have quite a few team members that are in Dallas specifically, and then the boring crew, we're all down here in Austin, and we're 3 hours away tops at any point in time. And that's something that whenever you have that ability to get on site and change things quickly, you can take advantage of those properties that have those inefficiencies because you're just going to button them up and just get them running really, really smooth, really quickly.
Right. Okay. So, Dee Dee, we're going to pause for a moment. Like you said, we got a lot of questions here, and I see you've been
Mm-hmm.
fielding those questions to the best of your ability. Can I
Yeah,
ask you to run us through some of those questions, and then we'll make sure we're caught up on that before we move forward?
I would love to. So Jennifer Johnson said, how are you going to increase occupancy? You just said you were going to do it, but you didn't say how. So why don't you expand on that a little
Yes.
bit?
Yeah, the saying the power of friendship is not going to work with this one. We are planning on making a very heavy advertising and marketing spend to get this up to occupancy, and then from there, it's about managing things. We have had an advertising agency for 20 years in our family, and whenever I can tell you that my dad can talk you under the table with all of the different metrics and Google Analytics and all this sort of stuff, I'm telling the truth. He's so good at it, and even just talking today with Steven about one of his other properties where they're doing some A/B testing on ads. Both of us just started getting these little like flares going off in our head because we're seeing things happening. It's something that doesn't go away. But that is what it is. Is we have the know-how to make a very targeted approach as far as getting new renters in, and then operating from a outside standpoint like a REIT or as close as we can at least and outperforming our competition in that respect.
I want to jump in on that if you don't mind and give
Yeah.
a little bit more information as well. So I don't know if you remember when Bryce also said they didn't have a problem leasing it up. That wasn't the problem. The problem was keeping those tenants. And so right now, this facility, because they increased their rents so drastically, they lost a lot of folks, and that's really hurt them. However, there's not an issue with leasing up. In fact, they're already starting to get back to bringing occupancy up again. So we don't see that being the struggle. The struggle for them was really keeping it. And the Borings already have experience with their other properties, getting those occupancies up and keeping them. And so that's really what they're planning to do with this facility as well.
Yeah, we can talk a little bit more about that. We have found that most people are sticky for two reasons. It keeps them, it's hot in Texas. Nobody wants to rent that U-Haul and pack up their stuff and go move it unless they get poked too many times. So our goal is to just do those incremental little rent increases that just steadily boost that NOI. And we, of course, do everything by the book, and we make sure that they're completely notified of all of the changes, but really give them just incremental increases. And like Steven said, we don't have to wait for a year to raise their rents. We can do it every 6 to 9 months. So we're able to do a $15 increase or a $7 increase just slightly to increase that NOI and increase the value of the property. So it's really a calculated ECRI strategy that we do on those rent increases. And then usually that makes it where they're not fleeing the property and running a mess because everybody got too much of a rent increase. So you just got to keep them sticky and keep them not wanting to rent the U-Haul and move things out. Okay, so somebody asked who owns a storage facility now and why is it for sale? I did answer that a little bit in the comments, but it's owned by KO Storage, which Bryce talked about. They like to build properties with expansion opportunities, lease them up, and then sell them. They're not long-term management players. They have a construction arm and they like to just buy and develop and sell. Um, okay, did we answered Theodore's, I believe. So one question was, is there a chance that a REIT could purchase this property before funding is finalized? We have it under contract, so I don't, if I'm understanding the question right, we have it
We're
under,
under contract.
yeah, we're under
That's
contract.
the way to really phrase it. We're under contract. We have an agreement with the seller. We're under contract. We're committed. It's like if you were to go buy a house and you're in the process of buying a house, it doesn't mean anybody can just come in and buy the house from underneath you. You're under contract. That's really the way you need to think about it.
Yeah. If I didn't understand the question right, then please do it again.
That's how I understood it. But yes,
Me too.
That's how I understood it as
Yeah, me
well.
too. But just could you comment on the supply of similar properties in the market? Are there any new developments expected to come online? I'd like to get a better sense of the competitive landscape. Bryce, you have done the comps
Yes,
over and over again.
I have, and they have not changed in the last year. There are two developments that are going on in, I believe, the 7 mile radius. It could be the 8 mile radius. Both of those are a couple of towns north of us and are not true comps. That being said, the comps that are in the market are mom and pop facilities down to the man, pretty much. There's not a single one of them that is owned by an operator that has something like 10 or even 20 facilities. They're all local. So that is something where we've kind of mentioned it a few times. We think that our experience and our ambition can really just make this market something that is very advantageous for us.
Yes. Okay. So are we going to go over later on about the debt and the loan situation, or are we going to, we have a
we
question.
don't have a specific slide to
Okay.
debt and loan. We can speak to it high right now. I would say at a high level right now. I mean, always Bryce or even myself, we'd be available to dig deeper into that. But Bryce, I'm gonna tee this one up for you as well, since you're the guy that does most of the underwriting.
Yeah, so we are constantly looking for the best debt option available. We have of three right now that we are deciding on, and we should have that decision made pretty soon.
Now the
Yeah, they're
question might
all,
be, go ahead, Didi.
yeah, they're all, I think everybody wants to know are they floating rates or what's the impact of interest rates?
Mm,
Yeah, so
yeah.
we are looking at only fixed rate debt. And so all of that that's the interest rate will be fixed. And so we shouldn't have we can mitigate that risk of that right there.
Mhm.
Um, so let's see. I will say this about storage, just for people that just want to know. Debt for storage is you get a little less leverage. You know, for whatever reason, people like multifamily better. So it's you get a little less leverage for the deal, but that's okay. We prove it in our and how we do business and how we make up for it in cash flow. So we love it.
Yeah, and the flip side
Mhm.
to that is, well, you have a little bit less leverage, you have more equity going in.
Yeah, for
Mhm.
sure.
So you're not over leveraged, and that really actually, when you take a step back, it puts you as an operator in a better, stronger position.
Yeah.
Exactly. It just gives you that higher DSCR, more cushion for whatever may happen, which I know we will be talking about those potential eventualities later on.
Yeah. Okay.
Uh,
So it says here you mentioned an Amazon distribution center in the future. Are there any other planned developments in the area?
yes. So the Amazon distribution center is going to be about $200 million worth of development. As of now, obviously, that's probably going to go up. And they're expected to bring about 1,000 jobs to the area. And it's only 2 miles away from our facility, right down the road on 67. So there's a high likelihood that the people that are going to work there are going to be driving by our facility every single day. Um, on top of that, there is another $640 million worth of residential and other commercial construction going on. We spoke about, about 1,000 residential units coming into play. There is, I believe, about $100 million worth of educational spending coming into play. I made a joke that it's about a football stadium. It's not. They're building useful things that are going to teach the kids, how to be useful in the future, and not just give each other concussions. But there's all this growth in education, manufacturing, data centers, all this sort of stuff that is just bringing a whole lot of jobs and a whole lot of households to the area.
Okay, so Paula had a funny question for us. The Boring Company, part of Elon Musk's Boring Company. Unfortunately, no. He likes to bore a hole. That's why they're called Boring Company, and we're just boring.
Yeah,
We
I really
are.
wish I had a few
That's
more
just who we
flamethrowers in
are.
my life.
Yeah. So unfortunately, no, but that would have been fun if he was like our brother or something. But let's get back to the occupancy rate at the other nearby storage facilities. That's been a question by Linda.
Yes, so most of these storage facilities are operating around 95, give or take, percent. And we're anecdotally seeing the same thing in our facility that's 30 minutes down the road. It's just largely because of the southern DFW market is growing so much that it's hard for storage facilities to not be occupied, especially with how much the population is willing to absorb that square footage. So, like we said earlier, this property was at 90% a year ago, and they made some poor decisions, and now they're at 84. But they got as low as about 70 and have been able to make that climb back in about, what, 6 months total?
Maybe 3 or 4, actually. Yeah.
Yeah, probably 3 or 4 is closer to it.
Yeah.
So,
Yeah, we love it when our competition is doing well. So if they're doing well, that means we'll be doing well. So
mhm.
we love that. So Brandon is asking, we talked a couple of times about the current pricing being too high. Are we discounting the monthly rate to normalize occupancy? If so, is that accounted for in the return in the IRR?
Yes, it is. To answer it shortly, so our whole first year strategy is to be catching up to the market as it is right now. And realistically, we're going to be about 1 year behind the market every single year. So, like I said, we build in these sort of conservative guidelines. We're not even saying we're going to catch up to the market. We're going to say we're saying we're going to be a year behind them every single year for the next 5 years. Do I absolutely want to beat that? Of course. But for our purposes, this is going to be a much easier target to manage.
So Jennifer has another question, which I'm loving y'all's questions, guys. This is great. Keep it up. Um, who is going to be keeping the property's books and accounting? Where will the investors be receiving their monthly, quarterly, annual reports from, and for tax reporting? Would you like me to take that, or which one of you?
Not
I would
me.
love to take that.
Go for it, Dee. You got
I would love
this.
to take that one. So I love our accountant and bookkeeping team, and they have the most clever name. It is storageunitaccounting.com. So they really reached for that name on cleverness. So we have used them on our 2 other properties. We report monthly and distribute monthly to our investors. So each month you will get a short description of what we've been doing for the month and how the property is doing. You'll get the P&L for the month, and then you'll get your notice of distribution, which we will run all through cash flow portal. And then storage unit accounting also does our K1s for our investors. And we were really, really proud of ourselves that we had all of our K1s to our investors by February. So we get those out really, really quickly. It's really important to us and to storage unit accounting. So they will be the ones doing those reports and tax reporting for us. So they do all of our K1s, all of our reports are from sales tax to property tax to just regular income tax. So I hope that answered all of those questions. And then Annie asked about a cost tag, which is one of my favorite things.
So, Dee Dee, can you take this one too?
Yes, I love that. So yeah, we'll be doing a cost seg on this deal. We already have a quote for the cost segregation. If you look at that overview of the property in the OM, or was the previous slide, you will see that this property has a lot of buildings on it. So it has less ground and more buildings, which means of the $6.2 million purchase price, we'll be able to do an estimated cost segregation or bonus depreciation on $4 million of the purchase price in year 1 that we will all split as owners pro rata on of how much you own and get a negative loss, paper loss on your income tax or for your income taxes. So your K1 will have that. But it's going to be a good one. We're really excited about it. Excited that bonus depreciation came back at 100% and excited that this property has a lot of buildings that we can depreciate. So it'll be a pretty decent cost segregation or bonus depreciation for all of us invested. Okay, so Boring and Co money and all of the investors, I think we have about 150 already in for house, $1,000 in for hard costs that we've done to get this thing to the acquisition. And many of the people that are of the partners that are on here are invested in the deal. So we'll have probably, I think it's about 5% of the equity will be coming from the GPs on this deal.
can we do really quick? I want to be respectful of the time. We got a lot of questions. So first of all,
Okay,
you guys are a
good.
great audience. Okay. This is great. We're pausing. Are we okay? Keep the questions coming. I want to be respectful of the people that might have a little bit of a hard stop here. There's a few more slides we can get through, and then it's just all Q&A from that point. So if you all are good with it, we can move on. We can go through the next few slides. And as promised, like we said, we promised we would answer all of your questions, and you guys are doing great at giving us all your questions. So please, please, please keep them coming. But what I'm going to do is I'm going to move things forward a little bit so that we can get to the dedicated Q&A. So keep thinking of your questions, keep putting them in the chat, and we will get to every single one. All right. Okay, so we've got a lot of excitement. Let's talk about what do the returns look like? We've talked about
Yeah.
IRR, equity multiple, cash on cash. You're like, Steven, that's great, but like, what does that really mean to me? Like, what is it going to look like in my account? So what we've done is we put together a grid, a nice table here that shows you an example of what this $100,000 investment would look like for you. We've broken this out over 5 years. That is the anticipated hold time and the sale. So what we have is this is the cash flow. We're going to line item this out for you with the total return of capital and then proceeds from the sale with the running total at the bottom. So let me explain this for you. The way this is underwritten is there is a preferred return of 6%, meaning you will always get a minimum 6%. And so we will start delivering that very early on, as quickly as possible. Our goal is to get it to you no later than 3 months in. Like Dee Dee mentioned, it's a monthly distribution, which is great. And I love that about the deal. So if you invested $100,000, year one, you're going to get 6,000. Year two, because of the way we're positioned, that's going to go up. You're going to get about 8,500. Year three, getting close to 10,000. Year four, closer to 11,000. In year five, you get about $12,000. So just in cash flow, you know, 40, a little over 46, almost $47,000 in cash flow. Then we're going to sell the property. And then you're going to get $100,000 back. And then we're also going to get proceeds from the sale. And that's going to be just shy of 80,000. So you would put $100,000 into this machine and we would give back to you $225,341. And that right there, that is basically your equity multiple right there. Your 2.25, that's your 225,000. Now, on top of that is the tax benefits, and that is your bonus depreciation that you're going to get. And so that is a whole other topic we could get into. But what's great about this, and like Dee Dee was mentioning, there's a lot of paper losses that are going to happen here. What that means for you is you're going to get to keep more of the money that you make. So I like to do an exercise here. You have something you want to say to that, Dee Dee?
No, I was just doing thumbs up. I
Oh,
like
thumbs
keeping my
up.
money.
Yeah. So I
Mhm.
like to do an exercise here where we call add a zero. Okay. And why is this important? Because why do we do this? Because what we all really want is passive income. Why do we want passive income? Is because we're looking for that financial freedom and time freedom. And the way you do that is very simple. You add a zero. So instead of doing $100,000 investment, you do $1,000,000 investment. And I want to show you what that looks like just for some perspective. And this is where the excitement is. This is where we have people coming in who are investing larger amounts, and this is why. So if you were to invest $1,000,000, think of what that does for your cash flow. So year one, $60,000, then you got almost 85, then almost 100, then you're at 100, then $120,000. The difference in this type of investment, as opposed to if you think of something like the stock market, you have to sell those stocks in order to get that money into your account. Here, you're not selling anything. You're making an investment. It's paying you, every month. In this case, it's paying you every month. And then at the end, you get all your money back in a big chunk. And so not only is it a great wealth accelerator, but it's also a great way to truly, honestly build passive income. If you're looking for great ways to build passive income, this is one of those really great deals that gives you that cash flow to do that. So and the reason why I'm having this, really pointing this out is and a lot of you might not even know this on the call, but you have the ability, if you don't know this, you can use what's called like a self-directed IRA. You can invest in these deals using your retirement accounts because where you've been saving up for years and years and years, and you want to get away from some of that volatility of the stock market. What happens when we mentioned Elon Musk and Boring Company, but what happens when he does a tweet or an X, whatever it is these days, and the stock market goes down, right? And that's happened. And we even saw that during COVID where we had years worth of losses in a matter of 30 days. And so this is one of those assets that's going to weather the storm and pay you out without you ever having to sell anything. So I like to just offer that perspective. And again, that's where this deal gets a lot of excitement. And that's why we're having, the people come in when we talk about $100,000 minimum. Really, this is why, is because people are looking at it from this lens. So with that, I want to go over to the risk and mitigation. Okay. So you're saying, Steven, this is great, but is it really all rainbows and unicorns? Let's talk about that. Okay. Risk, they are there, and we do everything we can to mitigate those. And I've spent a lot of time underwriting deals. And at the end of the day, underwriting deals is a lot of variables. And our job, if we do it right, is to control all of those variables as much as we can. So let's go through some of these. Rising interest rates. We had a question about this. What we're doing is anything we're looking at is going to be, fixed rate debt. That's what we're looking at here. And that's really just going to lock us in. And then also targeting a low prepayment penalty for refinancing or doing an exit on the deal, right? We understand that. We've been through that. We want to protect your investments. Self-storage price decline. Well, what happens if there's a price decline? Okay, so this is getting a little bit deep into some of the math that goes into this, but what we're assuming is that they're called cap rates. Like the cap rate would go up by about 20% per year, or the other way to look at it is the value might drop by about 20% per year. Our assumptions, our returns on this deal are assuming things get worse. If they stay where they are, you get a better return on investment, right? So when we go to sell the property, you're going to get even a stronger return. And then also through our business plan, we're forcing an increase in net operating income just by implementing the business plan. Rising inflation impact on NOI. So the fundamentals, we talked about a lot. That's why we like this area, this market, the submarket so much, the demographic. And we're, because also like Dee was mentioning, we're well capitalized. We're not over leveraged by going into this deal. And so there's other contingencies that come into play. And then the competition, we talked about that a little bit as well. No REITs. It's also because of the tariffs and construction costs, it is cheaper to buy than it is to build. So there's very little on the horizon of what might be built. And like Bryce has mentioned multiple times, there is no new self-storage planning, not in the area, not in Cleburne in and of itself. It's in like the next town over. So that is something that we just don't anticipate. If it was, we're still well positioned for that, to absorb that, because you can see we've been pretty conservative on the underwriting. So we've got a couple more things we want to cover, and then we're going to get into the questions. And so I've seen some more questions come in, which is great. We talked about this a little bit. I'm going to hit on these things. So what happens after we close the deal? Dee, you mentioned this. We're going to do monthly reporting. Okay, we're going to send a lot of information to you every month about the operations, the finances, the property performance, what's been going on, what's working, all those things. Monthly distributions, which is amazing. And that will start anticipated no later than month 3 or 4 after closing. That'll start as quickly as possible. And communication is great. So ongoing communication with you, they're going to have a monthly meetings. Okay, if you can't make the meeting, don't worry about it, because we're going to package that up. We're going to send it over to you as well. So now we get to the part where, okay, well, what does it look like if we want to actually move forward and get into this investment? So I'm going to walk you through that, a few easy steps here. What we need you to do is there is and I'm going to show you what that looks like here in a second, but we need you to review the packet. We're going to send you to the cash flow portal. You're going to log in there. If you have an account, if you don't have an account, it's very easy to create one. And you're going to have to fill out a questionnaire. What happens is you'll send that over to us. We'll review it as long as everything looks good. What we're going to do then is we're going to approve it, and then we're going to send you the information to wire your funds, which is important because we have a tight time frame on this. We are closing on the 8th. We are asking for funds to be in by the 29th. That's only about a week. Okay, we realize that. Some of you might be looking for a little bit more time. If you need that, just have the conversation with us. Okay, we want to get you into the deal if it's something you want to get into, but we have a lot of interest in this, and people are moving pretty quickly. All right, so those are your steps. It's very easy, very straightforward. As mentioned, it is $100,000 minimum investment. There's a question about this. We'll get to that in a moment. $100,000 minimum investment. What are the different ways you can invest? Cash, IRA fund, solo 401k, QRP, etc., trust, something like that. If you've got that and it's available for you, then you have multiple options of how you would like to invest in the deal. There is an investment packet, contains all of the offering information, the PPM, subscription agreements, and everything else that goes along with that. Here's what's important for you to know. There's quite a few people on the call. There's quite a bit of interest on the call, which is great. We appreciate your joining and all the great questions. Investments are going to be on a first come, first serve basis. Okay, so it's going to be, you do need to move on this. You do need to get the information filled out, but we're available to answer any questions for you. Okay, you'll find a nice, easy wizard to go through. Most people can do it on their own without having to ask any questions, but we're here to help you if you need it. The other thing that's here is we give priority to people who are investing larger investment amounts. So with that, and Dee, maybe you want to take this one, but there's a question here about, is it okay if somebody, maybe they're not in a position to do the full 100,000, but they love the deal, they're accredited, they're in a good position. Is that something that, like, we need to have a conversation with them and see if there's a spot for them? I think it's probably the best way we want to handle that. But do you want to clarify that, Dee? 1 second.
Sorry, I forgot that I put myself on mute.
Okay.
Yeah, I think just have a conversation with us, whoever it is that invited you to this webinar. Talk to them about it, and I think we would love to have that conversation with you. And there's probably a way that we can make it work. So just let's chat about it.
Okay, great. So
Yeah.
here's what we're gonna do. So in the chat, if it's not there already, what we're gonna do is we're gonna drop a link. So you have a couple options at this point. There's a QR code, and I'm gonna show you what that looks like here if you just scan that QR code, or we're gonna drop a link in the chat, and it's gonna send you to a page. On that page, it's gonna look like this. Okay. This is blank because we're going to take a recording of this video and we're going to put it there. So that's why this is blank. On this page, you will see a few options here, and there's some additional information. So if you're ready to invest, you're going to click this button, and it's going to take you over into the cash flow portal. And as soon as this pops up, you will see there's the Invest Now button. Okay. So that is how we're going to help you out with that. If you've got questions, if you're like, hey, Stephen, Bryce, Dee Dee, Janice, this was great, I've got a few more questions. Something came up after the call. Do you have a few minutes? Absolutely. So we're making ourselves available. This is my direct calendar. Book a time on there. I will make myself available. If I need to pull in anybody else, we'll do that. Okay. A few easy questions, a few questions to fill out, which is going to help make sure we get the right resource on to answer those questions for you. And then the other option here is, well, maybe you want to go back and review a little bit more of this. So we also have available for you. Here is a copy of this slide deck available for you on the page. And there's also what we call an OM, offering memorandum, with a little bit more detail that's going to go a little bit deeper into the underwriting. So that is when you're ready to move forward, you're going to scan that QR code, or we've got that link in the chat now. Okay. So go ahead and click that link, scan the QR code, and that's going to move you forward. But just that's one thing you need to do to move forward. Go to that page and we're going to answer all of your questions. Okay. A little bit more about the deal if you want to check out more on that page, but that's how we're going to take care of you there. All right. We are now to question time. We're back to that. So what I'd like to do is let's go to the questions in the chat or the Q&A, and then we'll cover these. And I think by the time we get through all that, we should have everybody's questions answered. So Dee Dee, you did a great job last time helping us work through the questions. Can you help us out again?
So I actually think that most of the questions have been answered.
Okay.
We actually were right to the end of them. There's lots of comments. There was a question about bonus depreciation, but then you covered it right away. So if anybody has any other questions about bonus depreciation, that is a really, really huge benefit of this asset and of this investment. So this would be a great time to ask those questions. And then just maybe mention, somebody was saying, mention who invited you. So if you would like to talk to the person that invited you to this webinar, if it wasn't Stephen, then if you just will reach out to, I'm sure they'll be reaching out to you, but if you would also reach out to them, they can schedule any kind of meetings that you would like to have.
And I have all their phone numbers, so really, I'm happy to connect you. Right, we run a big group chat, and I'm happy to connect you. We're a team in this, so feel free to reach out to me or let me know who it was you were working with. You're the main person, and I'll make sure you get connected so they can help you out.
Okay, in the PPM, does it have a guaranteed March date for release of the K1s? It does not. That's a great idea. I've never actually heard of that, Paula. I can just tell you that for our two properties that we do the K1s for, another property that we have, another group does the K1s for that. But the two ones that we are in charge of, that is their goal, is to have them out by February. So we did not have an issue with getting them late, but I know that that is an issue for most people, is getting their K1s. But it is not, I don't believe it's in our PPM. That's a great question, though.
Okay. Well, if the chat's died down a little bit, let's go ahead and go through the FAQs here. And then, like I said, we'll just stick around until there are no more questions. So, Bryce, you ready to help me out with this?
Sure thing.
All right. So, Bryce, how long is the expected hold period, and is there flexibility to extend?
Yeah, so our hold period we're planning on is for 5 years. That's what all the numbers are based off of. But if the cash flow is doing great, or there's investor appetite for it, we'll absolutely look at extending.
Great. Exit strategies. What exit strategies are you considering beyond a sale? Now, you kind of mentioned that right now. So anything else you want to elaborate on there?
Yeah, I think refi is pretty much the only other exit strategy that's being entertained right now. It's definitely not going back to the bank. That's not going to happen.
I'm glad it's not part of the business plan. All right. How do you stress test the numbers? How do you stress test the numbers against a downturn?
Yeah, so this is one of those where I just think this deal is so good. We have tested this with cap rates and vacancy rates and all sorts of things, and we can survive going down to 60% occupancy, but we can also, with our numbers, survive a cap rate going up to 8%. And the reason why that is so important is the last time that the national cap rate for self storage was 8% on average was during the Great Recession. So, the greatest recession that anyone on this call has ever experienced. Personally, that was as bad as self storage has ever gotten. And we are still going to be projected to not only not lose our investors' money, but also make them a near 2x multiple. So that is really exciting, in my opinion.
What type of reporting can I expect as an investor? So we covered that a little bit, but here's going to break it out for you. So we're going to give you monthly financial statements, performance reports, and then like Dee Dee mentioned, a K1. And so the K1, if you're a little bit new to this, what is a K1? So you're all familiar with a W-2, right? It basically says at the end of the year, you get a W-2 and you give that to your CPA. We're going to do the same thing. So for this deal, what we're going to do is we're going to give you your tax document. That's the K1. So that's what you need to take to your CPA, and that's why there's questions about is there, when am I going to get the K1? Because what we want to make sure we do is when you go to file your taxes, you've got that in hand. And any one of us can help you understand that in a little bit more detail. Next page here. What's a track record of tenant demand for non-climate units in Texas?
Yeah. So for the people that aren't from Texas on this call, it might seem really weird, but Texans love non-climate storage more than climate control. There is a huge appetite for it, and I think it's mostly because of affordability and ease of use. It's very easy to come up with your, F-150, a buddy, roll up the door and throw all of your crap into a 10 by 10 and then leave, rather than having to navigate the narrow hallways of, a 3-story or 4-story climate control facility. So that's a good thing for us. We're 100% non-climate. And then on top of that, over 80% of our units are the most in demand unit sizes. So that would be your 10 by 10s, 10 by 15s, 10 by 20s, etc.
I appreciate the visual there, Bryce, of the F-150 loaded up with crap. So
I've done it a few
Well,
times.
I was actually talking to an investor today and I asked him, hey, do you have storage? He's out of San Antonio. And I said, do you have a storage facility? And he goes, actually, I have five. He has five storage units that he rents for his business because he keeps supplies. And that's something that we've definitely seen in the Texas market significantly increase on our other properties is that people use these storage facilities for their businesses. So it is helpful for them to be able to go in and put their inventory if they need to, or their equipment, construction equipment maybe they're not using on the daily basis, and not have to buy or rent industrial space and have that additional cost. So he keeps inventory, he keeps his equipment in it, and essentially things that he needs for his business. He has them located strategically all over the place. So really, really cool. And also a lot of millennials and Gen Zs have side hustles that they're doing. And so we're seeing a lot of people keep their inventory and their side hustle businesses in storage. So all of those things it's great for them to be able to drive up, throw open the door, grab what they need, and then drive on out. So yeah, storage, drive up is really, really popular in the state of Texas.
I'm going to jump in here and also say I belong to a couple of large commercial real estate national real estate groups. And there was a training about 6 weeks ago, and storage, both self-storage and industrial storage, are two of the largest growing commercial real estate markets because of the side hustles, because of the tariffs and the fact that so many people are storing all the extra equipment and things that they need when they can buy in bulk, that type of stuff. So it is definitely in demand across the nation, and especially around here where the market's growing.
great. All right, let's move on. I'm also watching over here. We do have a few more questions coming in through the chat. We got three more questions here. We'll knock those out and then we'll jump back over to the chat. What happens if lease up is slower than expected?
I'll be honest, it's going to be hard to make it slower than what we're projecting. We have a less than 1% projected increase per month. And realistically, any good property management team will tell you that the target is actually closer to 4 or 5% per month in a lease up. So we know that we're close to that stabilization point, and we want to basically manage the last leg of this in a way that we're not going to lose occupancy while we are also increasing the income generated by the facility. So we are taking a beyond conservative approach to how fast we're going to be leasing this up.
Thank you. Next one is, what is the downside protection in this deal? We talked about this a little bit earlier, but can you recap that for us?
Yeah. So, all the LPs on the deal, the limited partners, will be getting a 6% preferred return. It means you guys get 6% of your investment back before us on the GP side of things will see a dime. And then we are acquiring this below replacement cost, meaning that no matter who is going to build next to us, it's going to cost them more money than it did for us to get in the first place. And then on top of that, they have the financial hurdle of managing a whole lease up while we're humming along. So that's huge. And then, for the kind of more money that is harder for me to explain, the bonus depreciation is just going to be so helpful for all of the investors on their taxes and doing all that sort of stuff. And I'm really excited we're able to get 100% back. I know we had a couple of facilities last year that we closed where we were only able to get 60%. So glad we got that 40 back.
Got that back.
Yeah.
Go ahead. Yes.
Great.
Yay. All right. So the last one here, can I invest using a self-directed IRA or solo 401k? Absolutely. Yes. We answered that. And so, anecdotally, I do that as well. I actually invest in deals using my self-directed IRA. I wish I could invest in this deal using my self-directed IRA. I can't invest in the deals I'm going to be part of, unfortunately. But it's a really effective strategy. And if you don't have a self-directed IRA custodian, or if you have questions about it, I've been down that path. I have a custodian that I really like working with, and they can answer all the questions. They can get you set up pretty quickly, and the fees are really good as well. So any of us on here can help you, point you in the right direction if that's something that you would like to consider doing for this deal. All right, so that brings us officially and formally to the end of the presentation, but I think we got a few more questions in the chat. Now, I know, Dee Dee, you're doing your best to answer those, or any of those that we want to bring up here before we wrap up the call.
So really quickly, when do we expect to own this facility? Our closing date is September 8th. So we definitely are moving right along on that. Are tariffs a big issue? Would it be wiser to look at storage near ports of entry? Um,
I can handle that one.
okay.
To put it bluntly, tariffs are a huge issue. They make it very hard to build new storage. And that's a problem that we've experienced at our other two facilities that we're running point on. But in this situation, it's a bit of an advantage for us because it does make it to where it's harder for competition to come in and build next to us. So, yeah, tariffs are an issue. So is the current employment climate right now. So all those things add to that replacement cost and make it more expensive and harder and a higher barrier of entry.
Yeah, I want to be clear on one thing that you just said. We're dealing with it on the other properties that we have, not because we underwrote for an expansion and we can't do it because of tariffs. It's because they're actually really doing well and we'd like to add more units. And right now it just seems like it'd be better to wait a little bit. So it's not a matter of we're not hitting our mark or anything. It's just a matter of we'd like to build more because there's opportunity and we'd like to capitalize on that.
But it doesn't mean people don't like their stuff any less,
It
right?
doesn't mean
No.
that. No, and people are still buying lots of things and we're still putting them in storage.
And think of all those foreign made goods that they're going to throw into storage, but now are more expensive because they're having to personally pay those tariffs. It's going to be even better, really.
Okay. And then, well, I think that's it.
We have, so there's one other question. There is some stuff that came in the Q&A. Most of it ended up in the chat. So Dee Dee, I don't know if you're looking at the Q&A. There's one last
I'm
question.
sorry.
This is from, no, I think we answered everything. So what does KO stand for other than knockout?
Yeah, I have no idea. And quite, that's really, I'm very nosy. So I'm very surprised I've never asked that question. But I never have asked that question. I don't know.
We'll try to find out. We'll do that. Okay, so that's for Paula. Paula, we'll try to find out. Jennifer, we answered your question about the minimum investment. Rubinsky Theodore, what type of debt financing will be used? Really, the bottom of that, will the impact be if interest rates change? We answered that question. The last one is from Annie. Who can I contact for a question offline, please, on real estate contract lawyer? Thanks. Annie, I was the one that invited you to this. I would just start with me, and if I need to pull somebody else in from the team, then I'll do that. Okay, so I would just reach out directly to me. Go ahead and tell me a little bit more about what's going on so I can get some context, and I'll do my best to get the answer or put you in contact with somebody that can help you out.
Yeah.
All right, I think that's it. I think we got through all of it. So I always like to do a quick little moment of gratitude at the end of these webinars. There's a lot of people, Bryce, Janice, Dee Dee, and you'll see SLT, that's someone from my team. A lot of work goes into putting together something like a webinar, even finding this deal. So I just want to say thanks to everyone who's been involved in all the work that's been done. There's a cast of people behind this that make it possible. So I just want to take a moment to say thank you for that. I want to say thank you to my team who just went just amazing this last week in helping support getting this webinar up, getting the landing page built, getting everything put together. So hats off to my team as well. And then lastly, those of you that stuck around to the end, even those of you that dropped early, but you've been a fantastic audience, and the participation is really what matters. Our promise was that we would answer every single question, and I believe we did that, but only because you took the time to ask questions. So thank you so much for taking time out of your busy schedules and giving us the attention and sticking around. We're almost at an hour and a half now. That means a lot to us. So I just want to take a moment to thank you guys for joining and being a great audience and participating. So with that, I appreciate it. Bryce, Dee Dee, Janice, anything else you'd like to add?
No.
Sure love talking about this deal. So if you want to
All
reach
right.
out to us, let us know. We can share more.
Reach out. We are here to help you. We are excited to have you be part of this deal. And we will follow up with you and just make sure that you've got answers to all your questions. Thank you so much, everybody, for attending, and we will talk to you soon. Thank you.
Thanks,
Thanks,
Stephen.
everyone.
Thanks,
Y'all have a
everyone.
good one.